Hey, welcome back to Everything Money. We're glad you joined us. It's just Paul and I today. We are talking about a reaction video. Paul has reacted to YouTubers in the past, both positively and negatively. We've actually got Jimmy's friendship now because of a reaction video, Paul. But today, Paul, we had so many requests in our Discord community for you to take a look at this video. I've watched it. A couple times. Some of these reaction videos, folks, can get quite fiery, where Paul starts bringing in people's mothers and it gets very volatile. But this one, I would not expect that's the case. Okay, this is Aswath Damodaran. I'm saying it wrong. I apologize. But a very, very famous value investor, Paul. And people...
I know who he is. He's an NYU prof.
People wanted to hear your thoughts on this. We probably won't go the whole time, but this is just quite interesting, Paul. So let's get after it. Value investing.
Hi, welcome back. In this, the third and final session on value investing, I'd like to take a look at where we've gone in the first two sessions. In the first session, I talked about what I call the glory days of value investing. Much of the 20th century, low PE and low price to book stocks outperformed high PE and high price to book stocks, and most of the legendary investors seemed to come from the value investing crowd. Then in the second session, I talked about the dark side of value investing, which is even in the glory days, there were some days that were not that glorious. In particular, there were periods of time where growth investing beat value investing.
Of course.
And on top of that, active value investing didn't seem to add much value, just picking low PE or low price to book stocks. I ended that session by looking at why value investing has failed, especially in the last decade. Now, leading it from 2010 through the COVID days, it's quite clear that the punch that value investing once delivered is no longer there. Low PE stocks are underperforming high PE stocks.
I love that.
Say that again.
I love that happens. I mean, listen, cycles have to happen, and people have to get to where they are now, where they say value investing is dead, right? We hear that all the time now, and it's like, okay, that's good. When we hear that, it means that we're probably very close to some sort of turnaround in that, because it's a bunch of young kids and younger adults who've never experienced a bad market will go and say, oh, wait, like, why should I invest in a 12 PE when I can have this company that's growing 30% a year and the stock is doubling every year?
Sure.
All right, go ahead.
Dividend paying and low dividend paying companies are doing better than high dividend paying companies. And I suggested that the reason you give for that phenomenon will lead to what kind of action you will take. For those who believe that this is a passing phase, all you have to do is wait. For those who think that this is all the work of the Fed, even central banks will lose power and you just have to wait again.
That's a very common thing I hear. Don't fight the Fed. I'm like, listen, at some point, the Fed will not be able to put enough bullets in the gun. It's just, things can't last forever. If the Fed could keep the stock market up forever, why wouldn't they? But they haven't done it. Like, COVID hit. And yeah, COVID rebounded, but it fell 40% in a matter of 1 month. I mean, if the Fed just had to print money immediately and do it, why didn't they? I mean, it doesn't add up.
Mm-hmm.
So be that the world has become a flatter place. Things that were exclusive, being able to find the data and work with it, are no longer exclusive. And on top of that, in a changing economy, it might be time for value investing to re-examine how it approaches investing.
I would say, Paul, that really spoke to me, the idea of these numbers are now out there. I mean, when you started investing in high school, you told us stories that you would call the Akron Beacon Journal
from the payphone in the Commons, remember?
From the cafeteria while I was grabbing ass, and and it's like, it's all out there now. I mean, you fire up TikTok and people are just like, it's like a daily thing, especially for young people. So we talk about how the idea of, like, it's positive that young people are starting to think about saving, but when they start maybe gambling on margin and options.
Well, the one criticism of Robinhood and many other of these apps is that it gamified investing. It didn't make it about investing. It made it about, picking this, that, and the other that's going to go up and down every single day. You know what I mean? So, the example I always give is when the caddy at the country club I played golf at tells me I'm wrong about Tesla, Palantir, and Bitcoin, the 17-year-old kid, I'm like, okay, that to me is an indicator. It's like Peter Lynch always said, the cocktail party. If I go to a cocktail party and everybody's telling me what to buy, stocks are too overpriced. If they feel bad for me for what I do for a living, probably the right time to buy stocks.
Yeah, he keeps going, Paul. There's a lot in here.
In this session, I'd like to build on that concept. I'm going to argue, and this is just my point of view, and of course you can disagree with me, I think value investing has lost its way. There was a time when value investing brought something to the table. Maybe when Ben Graham published Security Analysis, it clearly made a difference. But since those days, value investing has lost its way. And in fact, there are 3 R words that I use to describe value investing, and none of them are complimentary.
This is where it gets into
The first is value investing has become incredibly rigid. It is full of things you're not supposed to do. You can't invest in stocks that don't make earnings. You can't invest in tech companies. By carving these rules, value investing has removed larger and larger segments of the market from your universe. It's also very ritualistic. There are things you're supposed to do as a value investor, and God help you if you deviate from the script. What are these things?
I don't agree with that.
Go ahead, Paul.
I don't know. I don't know if I agree with that. I look at security analysis was a very rigid way. But then Philip Fisher wrote his book, Common Stocks and Uncommon Profits, where he brought about the whole idea of, listen, growth is an important part of value.
Mm-hmm.
And maybe if he's just comparing security analysis, that might make sense. I mean, security analysis is all about buy, less than net working capital, buy less than assets, buy less than, book value. And I get that. And even that investing, I don't like doing. I don't like doing the investing. If you guys have seen my videos, these videos, I want to find companies that are stable, that are growing at reasonable rates, but that people have dismissed. I'm okay with Palantir. The problem with Palantir is I don't know what the future is, and I can't determine the future very easily, especially the number of shares there. If I had a better understanding of how they're going to make money and their share selling amount, I could value Palantir. But if I can't value it, I move on. It's easier for me to value a Google or a Microsoft or Apple because there's a more established history that I can then determine, hey, will these companies be around for a while? Yes. And if so, can I reasonably determine a range of where I think they're going to end up making money? But I do think maybe he's right on this one, actually. Now that I talk about it, like if he's just talking about security analysis, then I agree with that. Like even security analysis with me, I tell people don't read it. We're not looking at just price to book. We're looking at earnings growth and all that stuff. Go ahead.
Every year, you're supposed to pay homage to Warren Buffett. You're supposed to claim you read Ben Graham's Security Analysis. And finally, value investing has become very righteous. A lot of finger wagging in value investing.
That's
where
true.
they tell the rest of the world how shallow they are, how speculative they become.
I've done that. I do that all the time. But the reason being is I sit there and say, you're overpaying for growth. You're not doing the numbers. Every investment is the present value of all future cash flows. And I am righteous when I say if you don't look at that, then you're missing something.
Mm-hmm. Or stupid.
And I'm going to bang your mom.
Punishment that is coming down the pipe. It's rigid, it's ritualistic, and it's righteous.
By the way, pause. So I have emailed him before, and he never responded. It was like 3 or 4 years ago. So Aswath, if you could please just respond to my email, I'd appreciate it. I'm a YouTube celeb now.
We'll have you on the show.
With 84,000 subscribers.
We're flossing. We can have you on the show and we can debate this in live, Paul. That'd be
There's
wonderful.
no debate. Like I agree with him. I mean, now that I think about it, he's right about the security analysis. It has become way too rigid.
Mm-hmm. Oh, wow. Okay. This is not where I was expecting you were going to go, but okay, here we go.
Investing to rediscover itself. It's got to go back to basics. And I'm going to make 6 suggestions. And again, you can add to these suggestions and remove those you don't agree with. But here are my first suggestions. If you're a value investor, I would expect you to even understand what value is. I am amazed at how many value investors I run into who have no idea what the difference is between value and price. You've seen me use this distinction before, but value is driven by cash flows, growth, and risk fundamentals, and price is driven by demand and supply.
I don't like the term risk, but I got you. I understand. I don't like the term risk. To me, risk is merely a price you pay for something, and I know it's simplistic, but maybe it's but for sure, cash flows and growth. What I always talk about. What's the cash flow? What's the possible growth from it? I always say that.
Yeah.
Factors. And the reason I emphasize this is if you're a value investor, you should be focused on value, not on pricing. That said, if you look at how value investing approaches the world, almost every tool that value investing uses is a pricing tool. You pick low PE ratios, that's not valuation, that's pricing. So while value investing talks about value, much of what you see done in practice is pricing. And if you truly accept the fact that value is what you're searching for, we know what drives value. Value is driven by cash flows and discount rates. Cash flows are driven, if you want to break them down into how fast revenues will grow, what your margins will be over time, and how efficiently you can deliver growth. And
Pause.
discount rate.
And look at our, what is our stock analyzer tool? It talks about what's your revenue growth, what are your margins going to be, and do some sort of valuation discount based on that. That's it. That's exactly what our software does for you. The stock analyzer tool does exactly what he just said. It says, what's your revenue growth going to be? What are your margins, and what multiple are you assigning to it? Great. This is your value in whatever number of years you want.
Yeah, I find all too often when watching some other YouTube channels where they're sort of talking about the grand futures of some of these companies, the idea of price and value is they just bring up a price, and then you see in the comments, boy, I'm buying it. Anything under blah, blah, blah amount, I'm buying. And I always think, why? How have you gotten to this amount? And then when it has a rise, Paul, or maybe a dip, they start resetting their values based on, I don't know what.
And somebody once accused me of that. They said, what do you think the S&P is worth? And my number was going up. They're like, so your S&P value is just going up because the S&P is going up? I go, no. It's going up. As you see, my S&P value isn't going up with the market. It's going up with GDP and income growth. That's what I care about, because as he said, what matters? The cash flow. I look at the cash flow of the market and say, okay, what are they going to earn over long periods of time? And there's a multiple to be paid for that. That's it. I don't care if the S&P is 5,000 today, 50,000, or 500. My value is still the same. Mm-hmm. Right? So that's the exact thing about, and that's what he's talking about here, is what drives the value of a business. Well, what drives the value of the stock market? It's going to be the total cash flows of the business, of all the businesses combined. And that's largely driven by the economies they're in. All right, let's go ahead.
What you demand as a rate of return will be driven by a risk-free rate and a risk premium. This is true for all companies. And to the extent that there's a risk of failure, you have to bring that into value. Now, if you're a value investor and you believe these are the drivers of value, we're ready to take the next step. And the second step is you cannot make avoiding uncertainty the center of your investing game.
Is that the center of ours? Yours?
No. Every single time we do a stock valuation on stock analyzer tool, there's uncertainty. I don't know what's going to happen in the future.
Yeah, okay.
But what I'm doing is saying, okay, do I think this $500 billion company is going to grow at the same rate it's done for the last 10 years? Maybe, maybe not. I was wrong on Microsoft and Apple. I remember 5-6 years ago, somebody saying, Paul, what do you think from a value perspective on Apple? And I said, it is a phenomenal value play if you believe their growth rate will be sustainable. It got better. That's why I was wrong on Apple.
Yeah.
I just didn't think a company that had $70 billion in revenue, whatever the number was at the time, was going to be able to grow that much revenue that fast in the future. I just didn't think so. Is that reasonable? I don't think it's an unreasonable assumption, but you can't avoid uncertainty. If you want to avoid uncertainty, buy treasury bills that are now paying 2%. That's what you should do. Mm-hmm. Because that's what he's talking about, the risk-free rate. The risk-free rate is essentially, what's the U.S. government going to pay you for your money? And over longer periods of time, they'll pay you a higher return. 10 years is what, 2%? But at the end of the day, and then he's talking about the premium you would get for risk. The problem we've had recently is that risk-free rate has dropped so much that when you put a premium, the premium even is a low number, so it's able to drive up values, because as interest rates go down, your values are going to go up. And that's what he's talking about here. Maybe that's what he meant by risk. But for me, you can't avoid uncertainty, but you can be more cautious about it. Mm-hmm. That's all I'm saying. Now, at what point are you just beating a deal to death? Yeah, I get it. But I'm not sitting there saying, oh, okay, so Apple's grown 10% a year for the last 5 years. I'm going to assume it loses 20% of revenue for the next. No, I don't do that. I sit there and say, okay, let's say they grow at 5% a year for the next 5 years. Let's see what happens there. What happens number? Oh, wow. It's still a good investment. Let's go look at it. I want to take conservative assumptions that are based on reality and say, am I still in the ballpark? That's what I'm trying to do.
Unfortunately, that's become true for value investing. I can't buy that stock. Why? Too uncertain. That's absurd, and here's why. If you think about companies moving through the life cycle, young companies, teenage companies, companies that peak at their life, middle-aged companies, aging companies, declining companies, it is true that there's far more uncertainty early in the life cycle than in the middle of the life cycle.
Like Palantir.
If you say that you're going to avoid uncertainty at any cost, here's what's going to happen. You're going to be stuck in the mature phase of the cycle, and all you're going to be doing is valuing mature companies. You're removing from your investing universe.
Pause.
Is this true?
This is true, but it's what I like doing. My goal is to find mature companies that the public misprices because it's not fun or sexy anymore.
That's fair enough.
That's what works for me. He is not wrong. I am trying. Gary even said the same thing. Paul, you're really keeping your universe of stocks very low. I said, yep. It's okay for me. But that's what works for me. Doesn't mean it's going to work for you. But Gary has companies that he won't even disclose to us because they're so small that if we knew about them, we could move the market very quickly just by knowing about them. For me, because I remember another thing. I sell covered calls on my deals. I sell puts on my stocks. So if I do that, I have to keep my world to a large enough mature company that I can sell those options on. And I'm okay with that. Because for me, I have enough. We're just beating the market with options by a few percentage points a year will yield me way more money than I need in my life.
Yeah.
So why go, I'm too lazy. I don't want to go investigate a $50 million company that nobody's ever heard of because they have more inventory on hand than the company's worth. That's just not my goal. Doesn't mean it's wrong. It's just not my goal. I want to find mature companies, S&P 500 companies that everybody's overlooking because look how boring that company is. Yeah, good.
That's what we like.
That's what I like. Yeah, a lot. Now, the smaller and smaller the company is, the more immature, early stage company, the less people are evaluating it. Of course.
Yeah.
All right, go ahead.
Well, in the end, I think for normal viewers is I've been drawn to whatever you've been doing because a lot of times in my life through my multi careers is if I've just followed someone I really look up to, it brings me up to a certain level that I find enjoyable and
but I'm shorter than you.
Oh, wow, that's good, Paul. All right, let's keep going.
Thank you.
Those undervalued young growth companies. And remember, young growth companies can be just, in fact, they're more likely to be misvalued than older, more mature companies.
Yeah.
You cannot make avoiding uncertainty the name of the game.
But that becomes a justification now for younger companies. Oh, well, you don't know what's going to happen in the future. So therefore, I'm like, okay, but you can still, let's put some sort of number to it. Okay, let's say they grow at 80% a year for the next 10 years. Oh, they're still overpriced. That's my point.
Yeah, and I think going back to what I just said, folks, if you're watching along and you consider yourself sort of a normal person as Paul, I went actually through the years of these crazy swings. I owned tons of Tesla, Amazon, and Bitcoin.
And Netflix.
And so I was confiding in you like, oh my God, I lost $12,000 today because Elon Musk tweeted something or a Bitcoin buyout happened. And so if you're at home and you don't like those swings and you want to maybe get a little more conservative, and in the end, Paul, I've put myself in a position to most likely be quite wealthy by the time I get older in life.
Yeah, and that's my point. My point is you will be very, very wealthy older in life without having those scary stocks where every single day you're like, oh my God, I hope Elon doesn't tweet something that's going to screw this
That's
stock.
what I'm saying, Paul. I mean, how many of, if you're watching, if you've ever had a moment where you lost money in the stock market and then hid this from your spouse, I've probably done that, Paul, you know, made a play. Go on.
I will ask you a question. Who's the CEO of Procter & Gamble? Who's the CEO of Johnson & Johnson?
I have no clue.
Who's the CEO of Microsoft?
Not Bill Gates?
No, not Bill Gates. Who's the CEO of Google?
Yeah, I don't know.
That's my point. Like, buy companies that you don't have to rely on. And by the way, I love Elon Musk. I just think he's a brilliant man. But
yes,
the guy literally tweets like, "Mamma ding dong," and all of a sudden everybody's like, "Oh, he loves blah blah blah. Let's go." It's just, come on. This is not investing. I mean, this is what I look at it like. I want to find the boring companies that nobody knows anything about, that have stable cash flows, that are growing at a reasonable rate with the economy.
Sure.
That people are going to go, too boring. I'm not going to own it. Great, I'll own it.
Yeah, we'll get rich slow.
Yeah.
Here we go.
The reality is there are no valuations that are certain. The kinds of uncertainty you might face might vary across the life cycle, and there might be more uncertainty early and less later on. But uncertainty is a feature of investing.
Listen, I love this guy. I would recommend everybody go watch his videos. I love him. Mo and I one night just started watching him. So I guess I'm lying when I say I don't watch videos, but it was because Mo was over and we were just watching it like it was on TV.
Yeah.
He's brilliant. He's very smart. As you can tell right here, he's even willing to call out value investors and say, wait a second, guys, we can't go. And I do think times have changed, even in terms of price to book. People have asked me, why don't you look at price to book? I look at it going, and that's a testament to me that I've even changed my view of value investing. Like, you know, back in the day, everybody was a manufacturer. 80 years ago, it was manufacturing. It was locomotives. Like, what kind of assets did you have? Okay, now it's much more service oriented. Like, what assets does Microsoft have? What assets does Google have? Some office. I don't even care when they build an office building. Who cares? It's a drop in the bucket. Who cares? So that's where we've adapted as the businesses, but it's still a present value of all future cash flows. I don't care any way you look at it. Look at everything money. What are the assets for everything money?
Assets?
Yeah.
5 cameras and one handsome lumberjack.
And I'm going to sell the handsome lumberjack because it's just not yielding me returns.
I agree.
No, but literally our assets are the computers, this monitor. I mean, if you value it based on this, what is this total? $20,000?
Yeah.
I mean, the company's generating, I look at it going, no, even I don't look at it, but is there a cash flow to it? Yes, every month we get cash flow and it grows. And it's like, okay, there's more to everything money than just cameras and computer screens. Why? Because the world has changed. This business was not around 50 years ago, couldn't have been around 50 years, couldn't have been around 20 years ago.
Right.
The world has changed, but at the end of the day, it's still cash in, cash out. What's the net left to you? That's it.
That's our take.
This guy's brilliant. Just go watch his videos. It's a little dry, but if you're willing to learn, this guy's a brilliant guy.
Nice, Paul. Yeah, I'm gonna reach out to this guy as well, see if maybe he likes me more than you. I mean, I would assume.
Probably.
Yeah. So that's our take. Follow, thumbs up. Join our community. We talk like this. We appreciate the people in the Discord chat who many people wanted you to look at this video, Paul. And I was gonna say in the end, Paul, if this guy came here from New York and sat down, could he sway you into a new way of thinking? Or you just...
Oh, sure. I mean, listen, he's a brilliant man, and I'm going to listen to him, but I've agreed with a lot. I mean, I didn't think about the security. I'm like, yeah, he's right. The security analysis way of doing things is not working anymore, but there's a reason for that. It's a justifiable reason in the shift in the way our economy is structured, the way businesses in our economy are structured.
Do we have a righteousness of value investing where we potentially overjudge...
Yeah, I guess, listen, I could understand that argument. If I'm in somebody else's shoes, I'd be like, man, this guy's just so closed-minded, blah, blah, blah. But I'm closed-minded by saying an investment is the present value of all future cash flows. Give me the growth for this company. Give me a margin. Great. It's still overpriced. No, Paul, the stock's going to go up. Guys, over long periods of time, stocks are driven by revenue, profit, cash flow. That's it. If you don't agree with that, then we shouldn't even have a conversation.
I agree, yeah.
It's like sitting there and saying, this
2
is
plus 2
white.
equals fish.
This is white. Yeah, 2 plus 2 equals fish. Can you agree that 2 plus 2, count these fingers? Yeah, it's fish. Okay, let's stop having a conversation. But if you agree with me that the present value of all future cash flows is what an investment should be, then we should have a conversation about, okay, what he's saying is maybe we probably differ in how we discount our cash flows.
Yeah.
Because I don't base it on the risk-free rate of return. Neither does Warren Buffett. I mean, but Warren Buffett does. I do not. I base mine based on what kind of return do I want to get on my money. If I want to get a 10% return on my money, I don't care what the risk-free rate of return is. If interest rates were 8% tomorrow, then that's the risk-free rate. I would still make my analysis based on 15, 12 and a half, and 10. Mm-hmm. I would still do that even if rates skyrocketed. So I'm just being consistent there. Now, does that leave me out of the market for long periods of time? Absolutely. Does it make it hard for me? I own 11, 12 stocks now. That's great for me. I'm like, great, I'm buying. Now, is it a lot of money? No, but I'm building a position and I'm okay with that because I'm only 40.
Well, when you say a lot of money, I mean, it's still hundreds of thousands of dollars.
Right, but I meant relative to my net worth.
Yeah,
I'm not allocating a lot of money toward my net worth into stocks right now. But over time, I'm only 40. I never plan on retiring. So my outlook is 60 years. I'm going to die at 100. Damn. Okay, probably around 100. All right, then I'll just wait.
And you're getting so thin. I mean,
can you believe this?
110 is right in the wheelhouse.
169.9 this morning.
Look at you.
I was 169.5 yesterday. Guys, on August 24th, I was 183.6.
So fat. I'm kidding.
And now it's September 30th, and I'm 169.9. This is a small. These short, look at this. I don't have the extra notch for my belt.
Me too, bro.
I used to go to the 4th, and now I'm at the last one.
Last one.
And I need another one.
New belts for Seth and Paul.
Yeah.
Fondle thumbs up so we can buy belts. Talk to you soon. See you next video.